Good morning. Today, the Subcommittee on Telecommunications and Finance addresses some of the significant issues raised in the often stormy debate about the proper structure of the financial services industry in our nation. At the vortex of that debate are questions relating to whether Congress should permit increased securities powers for banks. I would like to begin by welcoming two very distinguished and busy gentlemen, both new chairmen of two of our most important public institutions, Alan Greenspan, Chairman of the Federal Reserve Board, and David Reuter, Chairman of the Securities and Exchange Commission. I understand that Mr. Greenspan is testifying before Congress today for the first time in his capacity as Chairman of the Federal Reserve Board. We were, of course, privileged to have Chairman Greenspan in his private capacity testify before this subcommittee earlier this session, and it is a privilege to have you testify in any capacity before our subcommittee, Mr. Chairman, on issues early this year relating to tender offer reform. We are pleased to have you with us here today, and we want to take this opportunity to congratulate you on your new position.
Thank you very much, Mr. Chairman.
I know I speak on behalf of all of the members of the subcommittee when I say that we look forward to working with you. We are also pleased to have Chairman Reuter of the SEC. It is a pleasure to see you again, Mr. Chairman, as well. Mr. Reuter has already testified before us in his current capacity, but we welcome the opportunity to hear for the first time his views on the matters that are before us today. We welcome both of you and thank you for taking the time to join us. The debate about the proper structure and role of the financial services industry is not new. Almost since the very passage of the Banking Act of 1933 and its Glass-Steagall restrictions, commercial banks have argued that they or their subsidiaries and affiliates should be able to conduct securities activities. What is new is the global scale of the debate, the breadth and international implications of the questions raised and the arguments advanced, as well as the international stage on which the issues are being played out. If it ever was, this debate is no longer mere intellectual wrangling. It is rather a critical and timely debate whose arguments take the form of real-world actions such as rulings by the Federal Reserve Board and the Comptroller of the Currency. It is a debate that has real consequences right now and that has the power to bring about a major and abiding reconfiguration of the U.S. capital markets and enhanced international competitiveness in the future. Change of that sort, even positive change, may be tremendously disruptive with significant and far-reaching consequences. For these reasons, we enter this debate with great caution, and we intend to evaluate the issues and arguments on all sides with immense care. But why even enter the fray? Why take on such divisive and complex issues? The short answer is that Congress must be at the center of formulating financial policy for this nation. In this decade, the drama about the future of our financial industry has been unfolding in the courts and the regulatory agencies. We in Congress have been on the sidelines while the Glass-Steagall wall separating commercial from investment banking has taken repeated blows and is threatening to crumble. Yet for better or worse, Congress erected the wall, and it should be Congress alone that restructures it if such change is needed. We want to ensure that our financial institutions remain competitive, both domestically and internationally. We should not allow our position of preeminence as the center of the financial world to be undermined. Yet we need your assistance in understanding the true extent of and underlying reasons for banks' apparent and growing lack of global competitiveness. Is it a product of regulatory disparities? Is it a product of unalterable cultural differences? Is it a combination of the two? We do not enter this debate with any preconceived notion about its outcome. We will listen to the arguments on all sides, weigh their relative merits, and proceed according to our best judgment. We should remember in our consideration of these issues that deregulation in the financial services context, particularly with respect to diversification of products offered by banks, is not synonymous with a lack of supervision. Indeed, we should not countenance deregulation in this area without vigorous supervision and the imposition of appropriate structural solutions to the risk posed. We come to these discussions armed with a healthy inquisitiveness. These are some of the questions we start with, so we anticipate that others will arise as we proceed. First, And we see this as a key threshold question. Have circumstances changed since 1933 such that the dangers perceived by Congress at that time no longer exist, or alternatively, do new, equally effective responses to those dangers now exist? Second, will a more fully deregulated system with increased and vigorous supervision rather than out-and-out prohibition better serve our nation's economic interests? Third, can we effectively insulate deposits from securities activities, preserve public confidence in our financial institutions, and preserve the safety and soundness of those institutions if the Glass-Steagall wall is lowered or abandoned? Fourth, can we make such changes without wreaking competitive havoc on the banking and securities industry? And finally, can we ensure that conflicts of interest and other abuses are not allowed to proliferate? Until we receive satisfactory answers to those and other questions, we will forbear from drawing any conclusions about the continued vitality of and need for a Glass-Steagall solution to the problems posed by the intersection of commercial and investment banking. That concludes the opening statement of the Chair. The Chair now recognizes the gentleman from Iowa, Mr. Talkey, for an opening statement.
Mr. Chairman, I have no opening statement, but I want to join you in welcoming our witnesses this morning, and we look forward to their testimony.
Great. Any other members seeking recognition for the purpose of making an opening statement? The Chair recognizes the gentleman from Tennessee, Mr. Cooper.
Thank you, Mr. Chairman. It's perfunctory, as you know, in these hearings to congratulate the Chair for holding the hearing, but my praise this time is even more sincere than usual. I think that we really have three new chairmen, you being the third, and I appreciate your willingness to hold hearings on what I consider to be a topic of absolutely vital national economic importance. In the past, the Government Operations Committee on the House side has probably been more active on this issue than any other committee in the House. And while that's a fine committee, and I in no way wish to disparage that committee, the Government Operations Committee has no legislative jurisdiction. So to me, it's very, very appropriate that we are taking up these fundamental issues. I've had some difficulty explaining to constituents and others in the political world exactly why these issues are so important. And I'd like to take a run at an analogy here and see if it fits. To me, there are really three layers of financial structure. The first, and the most superficially appealing, is catching the crooks. And to make the analogy to a financial house, to me that's looking at a structure with no major structural defects, but with a potential for abuse of the structure. For example, if you leave a door unlocked or a window open, a burglar can get in. We've had problems with catching some of these crooks in the last several months. But there's another layer that I think is even more important, and that's when the structure has some small defects in it, such as when the roof leaks, something like that. And that, in my opinion, is the level of importance of, say, tender offer reform measures that this committee is considering. But to me, there's still a more fundamental level, a basic level, that has to do with the structure of the building itself, to see whether that structure is sound, to see whether it can withstand earthquake, fire, wind damage, all sorts of threats from the outside that may be facing it. And to me, that's what we're facing here when we look at Glass-Steagall questions, to see whether our financial house is not only in order and safe and secure, but whether it is structurally sound. I have some doubts on that question. The Glass-Steagall law was a very fine law when it was first started. I worry, though, that today that we might be unnecessarily beholden to concepts that, whatever their validity in the 1930s, have outlived that validity. So I appreciate your holding these hearings today. I look forward to hearing the expert testimony from the witnesses, and I would urge you to hold continuing hearings on this subject in the future, because whatever its lack of public appeal, I think once the public begins to understand the trillions of dollars involved and the threat to the American competitiveness in this area, that the public will not only be interested, but enthralled at the importance of the topic. Thank you, Mr. Chairman.
Thank you. The gentleman's time has expired. Chair recognizes the gentleman from Washington, Mr. Swift.
Ask unanimous consent to submit a prepared text for the
Without objection, it will be included in the record.
Briefly, Mr. Chairman, I've been disturbed by a couple of trends that have been rather obvious in the last few years. The twin trends of increased administrative willingness to assert fundamental policy-making authority that should belong to the Congress. And the other trend is Congress's apparent reluctance to deal with issues that are highly technical, very complex, and esoteric. The two trends, of course, reinforce each other and lead to policy, very fundamental policy in the country, being made in inappropriate areas. Over the past three Congresses, we've seen a number of attempts to redefine financial powers that have been coming from the Federal Reserve, the courts, to a lesser extent the SEC, and it is time, I think, for Congress to assert itself. I think it's also true that we have seen this battle going on for the last few years as kind of a test of wills, with certain financial institutions pushing a congressional initiative and other institutions opposing it. I'm beginning to sense that there may be a certain amount of battle fatigue, and therefore it may be time for a reasonable compromise to be reached and energies spent on more productive things than simply fighting each other over the issue. We shall see. Again, I think that, that there is a twin concern: usurpation of fundamental policy-making authority by administrative agencies that is almost encouraged by Congress's apparent inability to act. I would like to preach restraint to the administration and encourage us to take some action on the contrary, so that we can get fundamental policy-making back where it should be. I thank the Chair and yield back my time.
Thank the gentleman. No other member is seeking recognition for the purpose of making an opening statement. We now turn to our first witness, Alan Greenspan, Chairman of the Board of Governors of the Federal Reserve System. We thank you very much again, Mr. Greenspan, for your appearance, and whenever you feel comfortable, please begin.
Well, thank you very much, Mr. Chairman. I plan to excerpt parts of my written text and request that the full text be included as part of the record.
Without objection, that will be so ordered.
Mr. Chairman and members of the committee, I welcome this opportunity to appear before the Subcommittee on Telecommunications and Finance to explore the structure of the financial services industry with an emphasis on the regulatory framework that applies to banking and securities activities. I wanted to express my appreciation to you for calling this hearing and focusing the attention of the Congress and this committee on the important issue of the basic rules that should apply to the financial services industries. Before turning to the questions of financial structure, I believe it is important to reflect on our starting point. We have the strongest, most competitive, and innovative capital market in the world. Our job is to preserve its strengths and make improvements to assure its role in a substantially more competitive world marketplace. Banking is a vital part of this capital market structure, and despite a difficult economic environment, this industry has shown extraordinary resilience and strength. It has carried a special burden in the transition to less inflationary economic climate as some of the major sectors it has financed. Agriculture, developing countries, energy, and real estate have been seriously and adversely affected by the transition, experiencing in some cases not only a relative slowdown in the rate of inflation, but actual sharp declines in prices. The banking industry is coming through this experience wiser and stronger. Securities markets also are adjusting to substantial change. The global marketplace involving 24-hour trading in a variety of securities is now a reality. There has been an explosion in complex new products and services, posing new risks and putting a new emphasis on capital adequacy. And here at home, attention has focused on a deterioration in ethical standards and the possible need to take corrective action. All of these concerns have led to a new and searching focus on how our financial structure can be improved. Mr. Chairman, your San Francisco speech pointed to many of these issues, including international competition, new securitized products, deregulation of interest rates, and non-banking organization expansion into fields traditionally thought of as banking services and vice versa. All of these developments have amounted to a very much more competitive environment for banking, while at the same time, banking has been frozen within a regulatory structure fashioned some 50 years ago. Among all these changes, there is one development that I believe is of particular importance and is now a permanent feature of the financial environment. This is the erosion of the role of banks as intermediaries in the credit-granting process as a result of major developments in data processing and telecommunications technology. These changes have taken the form of improvements in productivity, permitting the efficient processing of large volumes of transactions, the linking of geographically separate markets, and a substantial reduction of costs. These, in turn, have had a marked impact on the traditional role of banks, intermediation, whose function it is to substitute bank credit for the credit of the ultimate borrower. Now, extensive online databases, powerful computation capacity, and telecommunications facilities provide credit and market information almost instantaneously, allowing the lender to make its own analysis of creditworthiness and to develop and execute complex trading strategies to hedge against risk. The result is that the basic products provided by banks, credit evaluation and diversification of risk, are less competitive than they were 10 years ago. These fundamental changes will have a permanent effect on the competitiveness of depository institutions and will expand the competitive advantage of the market for securitized assets. As one important example of the consequences of these changes, we have seen a remarkable expansion of the commercial paper market as a substitute for direct short-term lending by banks to the most creditworthy borrowers. Since 1980, this market has more than doubled, rising from $31 billion at the end of that year to $78 billion at mid-year 1987. The same kind of securitization of many other types of lending has proceeded apace, involving everything from home mortgages to automobile loans. As you know, banks have not been able to participate fully in servicing this extension of their own natural markets because of regulatory restrictions. These same technological forces are now prevalent throughout the world. To remain viable in this highly competitive and innovative environment, financial institutions are seeking to have the broadest range of products available to meet the changing needs of their customers. Thus, we have seen investment firms provide traditional banking services such as short-term bridge financing, and banking firms, including American and Japanese banks that are under regulatory constraints at home, participate broadly in securities markets overseas. Mr. Chairman, you have suggested the fundamental test for determining the kind and scope of the required changes is what we will need to do is to serve better our nation's economic interest. You point out that in the process of considering removal of some or all of the barriers separating banking and securities firms, we have to ask ourselves a number of important questions, including A, how can we insulate insured deposits from securities activities? B, how can we ensure the continued safety and soundness of and public confidence in banking and securities markets? And C, how can we prevent conflicts of interest and concentration of resources? To these important considerations, I would add the corollary that our basic objective must be to promote a system which provides efficient services to customers, large and small, in an environment that promotes competition. As part of this analysis, I would add two other points that are of particular importance to the Federal Reserve, but are also of vital concern to the economy as a whole. A, we must have a system in which monetary policy can function efficiently, and B, maintains the integrity of the nation's payment system. There is, I believe, wide agreement on these goals. We accept as basic to our thinking that any combination of banking and other firms should take place within an organizational structure which separates the bank in such a manner as to assure that only the bank has the benefit of the support of the federal safety net, which includes deposit insurance and access to Federal Reserve lending. We also agree that attention must be given to the whole range of relationships between a bank and its affiliated entities to assure that confidence in banks is not compromised and that conflicts of interest are avoided. In addition, we are addressing such issues as A, the need for limitations on loans by a bank to affiliated enterprises or to customers of affiliated enterprises, B, the need for adequate separation of directors, officers, and premises, C, restrictions on the flow of confidential information, D, the scope of permissible joint marketing, E, rules on intercorporate provision of services, and F, the need for public disclosure of affiliate relationships. We expect to have specific recommendations on how best to achieve bank affiliate insulation, on the maintenance of safety and soundness, on preservation of conflicts of interest, and on avoidance of conferring competitive benefits that are unavailable to all competitors that are similarly situated. We hope that these recommendations will be valuable to the Congress as it proceeds with its consideration of the restructuring of our financial system, and that our recommendations will enable the American financial system to remain competitive, serving the needs of customers here and abroad without compromising the strength or stability of our financial markets. Thank you, Mr. Chairman.
Thank you, Mr. Chairman, very, very much for your very thoughtful testimony. We now turn to the question and answer period, and the Chair recognizes itself for an opening round of questions. Let me begin again by just trying to put this in the larger context, just so we can understand the way in which this debate should be framed, and you can help us to do that. In your prepared testimony, you indicated that the traditional role of banks as intermediaries in the credit granting process has been eroded by major developments in data processing and telecommunications technology. As a result of these advances, lenders can deal directly with borrowers without banks as intermediaries. At the same time, lenders have the computerized capacity to undertake their own analysis of creditworthiness and to hedge against the degree of risk inherent in any loan. Banks are basically on the sidelines in this process. My question, and I will ask it in its most brutal form, is why should we care? If the capital transfer process has become more efficient without any loss of, a loss of safety, should we care that banks no longer play an intermediary role? And let me just spin that thinking out on that question just a little bit. I am not totally unconcerned about the competitiveness of banks vis-a-vis the securities industry. But that lack of competitiveness, if it indeed exists, is certainly not what impelled me to hold this series of hearings. My concern goes much deeper than that. My concern is that 50-year-old laws are preventing banks from engaging in businesses and offering services that will make not them more competitive, but that will improve our economy and make us more competitive as a nation. Can banks, if subject to less product line regulation, assist our manufacturing sector by facilitating cheaper and easier export financing? Can banks safely and profitably serve as investors in the currently lagging manufacturing sector of our economy, as they do in Japan? How can a relaxation of product line regulations on banks help our trade deficit, our budget deficit, our employment picture? I do not think that bigger is necessarily better, and therefore believe that it would be ill-advised to relax Glass-Steagall restrictions solely so that we can breed U.S. banks to match the size of the large Japanese banks. What it comes down to, in my view, is that our witnesses in this hearing should not be telling us what we should be doing for banks. Rather, they should be telling us how less product line regulation can help improve our citizens' standard of living and our nation's economy, both from domestic and international perspectives. What I would ask you, Mr. Chairman, is that the perspective that we ought to have on this issue? And if it's not, could you help us to refine the question which we should be asking so that we can keep it squarely in front of us in the course of our deliberations?
No, I would essentially agree with you, Mr. Chairman. Let me just start by saying, should we care if banks basically contract? From a strictly economist's point of view, if the intermediation process which banks have been according the economy since their origination several hundred years ago no longer serves a useful purpose, if we can obtain precisely the same economic functions by other, more efficient means, then one would have to argue that banks per se, or depository institutions per se, are of no particular economic value to the system. However, what we have in our banking system in general, and very specifically in a lot of different variations, and I would add in here the thrift institutions as well, is an extraordinarily gifted group of people who synergistically understand the financial process and the financial system in a way that would be very difficult to reproduce in another form. So while we might, in one sense, say that a decline in bank intermediation and the dissolving of banking institutions has no immediate, direct, visible economic effect, the breaking up of this type of knowledge base, this institutional culture, is, I think, detrimental to the economy. And as a consequence, if it is feasible to hold these banking institutions in place and to function in a manner which assists in the financing of the economy of Americans both here and abroad, then I think that's a very important value to preserve. However, I would also share with you, Mr. Chairman, your concern that we endeavor to merely compete in the international markets because they're out there. I have observed, both from a position in the banking system and without, the interface of American commercial banking and investment banking, both here and abroad. And it is not particularly evident to me that size per se is where the competitive edge is. In fact, as I envisage it, the most competitive American banking institutions, indeed the most competitive banking institutions generally in the world markets, are not the largest. Size per se is not evidently something which is particularly useful, but skill, technique, capital is.
Right. Well, can I just follow up on this, on the state of our banking industry, so that we can get your sense of the cause of some of their concern, because some observers take a more, let's say, cynical view of the reason why banks want to get into this business. And I recognize that there are changes in the financial environment that have caused an erosion of much of the bank's traditional business, and I also accept that many of these changes are permanent. But how much, and help us to understand this as we begin the process, how much of the banking industry's current troubles are the products of poor loan judgment on their own part, bad luck in terms of lending to those sectors of the economy that have been hardest hit economically, and mismanagement of various sorts? In other words, first, how much is really the bank's own fault? And second, how much is really a fairly short-term situation that will be self-correcting?
Mr. Chairman, 20/20 hindsight is something which economists like myself would love to acquire. The banking business, by its nature, is risk-taking. Show me a bank which doesn't take any risks, and I will show you a bank which has no economic purpose. As a consequence, you need to evaluate the context of bad loans from the point of view that they will always be bad loans. I frankly don't know whether or not a good deal of the poor lending, which in retrospect is obviously the case, is the responsibility of poor bank loan procedures or bad luck. I would say, as a guess, most of it's the latter. Even the best banking institutions that I'm aware of, those with the most skilled loan officers, those with the most extraordinary techniques to preserve the safety and soundness of the institution, have been visited, as many have been, with bad loans abroad, bad loans in the oil patch, bad agricultural loans. So what I can say for certain is that I know of a number of individual instances of which I am familiar, in which one would have to conclude that one cannot question the basic abilities of the people who were engaging in these practices. That is not to say that there are many others who were irresponsible, guilty of mismanagement, and a variety of other things. But I would be inclined to say that is far more that is probably a very minor aspect of this problem. But what we really need to do is to go into the psychology and analytical procedures of loan officers and bank management in retrospect, and that I think is a very difficult thing to do. My own guess is that we will get through all of this, that these are temporary situations, and that bank management in the United States, as best I can judge, is really first rate.
So you're of the opinion that banks will regain their
Oh, yes.
footing?
No, I have no question about that.
Can they regain their footing and create a solid environment for themselves working within the guidelines of Glass-Steagall? I mean, in other words, are there additional reasons why we should enter into this minefield that is loaded with conflicts of interest and potential difficulties that were identified when the law was put on the books, that go beyond, you know, shoring up the banking industry? Can you just give a shorthand summary of the reasons why we should, why it's worth our risk to get into?
First of all, let me just say in preface that we at the Federal Reserve are examining this issue at this particular stage and have not drawn a specific conclusion. I would say that we should not in any way consider any changes contemplated as shoring up the banking industry. If that is what we're doing, we're probably making a mistake. Okay. I would view it more in terms of the way you originally put the standards of determination.
Okay. I thank you. My time has expired. The chair recognizes the gentleman from Iowa, Mr. Taki.
Thank you, Mr. Chairman. Welcome, Chairman Greenspan. It's good to have you here.
Thank you.
I enjoyed listening to your testimony, and it seemed to me that you made a fairly good case for making some changes in the current structure. But let me approach it a little different way. Suppose Congress does nothing. Suppose, or perhaps instead says we want to patch the wall that was erected by the Glass-Steagall Act. What is the impact of that kind of policy on the economy of the nation generally, on the banking industry more specifically, and what are the implications for the average American?
Well, Congressman, you're raising precisely the questions that we at the board are raising to ourselves. And I would hesitate at this stage to give you even preliminary answers, because what we are dealing with here is something really quite fundamental. We've had regulation of this particular type in place for a half-century. We've gotten used to it. We've structured our institutions around it. We've looked for ways to get over walls, break down walls, do a number of things. And one has to be very careful when one evaluates changes of fundamental institutional structure that has prevailed for more than a generation or two, because you don't really fully understand how the system is adjusted to those regulations. And before you unwind them, it's important to understand that you have to unwind the regulations in a manner which does not undercut the economy. So I would say at this stage that we don't yet fully understand precisely all of the implications of moving in the direction of a change of great significance or even elimination of Glass-Steagall. We're getting there, and at some point I think we will be able to present to the Congress our best judgments on all of those very important questions.
Maybe I better back up a step then. My reading of your testimony suggested to me that you were urging us to act. That in fact you were suggesting that we should expand the bank securities powers. Am I reaching the wrong conclusion?
No, we at the Federal Reserve have expressed a number of concerns about the problems that we are discussing today, and have, in a sense, initiated an expansion of a number of powers. What we're talking about today is a very fundamental shift. I must say to you that my professional inclinations move in the direction, as I've stated, for reasons I've stated in my actual text. But let me just tell you very specifically where the real problem in my own judgment lies. If, for example, we did not have the federal safety net, that is deposit insurance, access to the discount window, the access to the payment system, then I would say there is no rational reason to have something which is, in a sense, a wall between securities, investment banking types powers, and commercial banking type powers. The one issue that we have to be certain that we can effect is that the essential federal, quasi-federal subsidies which are built into the deposit insurance, which enables commercial banking institutions to borrow effectively with a government guarantee, as well as the other safety net characteristics. What we want to be certain is that subsidy, which serves a very fundamental public purpose, is not employed for other than commercial banking. So for those of us who are inclined in the direction, as I am, in tearing down this wall, we also have to be in a position to stipulate that, in effect, by so doing, we are not, in effect, allowing the investment banking powers which would accrue to be financed by federal guarantees.
So you are concerned in substantial part about the problem of unfair competition, a federal subsidy that would be essentially used by the banks to compete unfairly. I guess that is a little different from what I have...
Can I just substitute? The answer is yes, but I have a more fundamental issue.
Okay, please continue.
The same views that lead me to like to see a freer economy are those views which also makes me very much disinclined to extend federal subsidies. And what I don't want to see happen is that the subsidy structure underlying the federal safety net not be extended beyond what the Congress very specifically constructed it for.
Okay, I guess my concern has been, and what I've tended to focus on, is the issue of the stability of the banking system. That if you allow the banking system to expand into areas that are not protected through the deposit insurance system, or are not and are less inherently less stable, that then you might destabilize to some extent the banking industry in the country and raise new concerns among average consumers. Is that a concern that is real in your view, or is it something that we should not focus our attention on?
Well, I'm not inclined to say there are areas which one should, by definition, not focus on. It's usually those which come back and hit you in the face.
Is it a well-founded?
Yeah. I don't. I'm not inclined to be concerned terribly much about that issue. I mean, I understand that it could be a problem. It doesn't bother me that much.
You must tell me why. Maybe I should back up a little bit. My understanding is that's essentially why we had the separation in the first place.
Oh, sure.
Was because of concern about the stability of the banking system. Why is that not a valid reason for maintaining the separation today?
Well, first of all, I think we have to go back. If you read the history that led up to the Glass-Steagall Act, some of the activities that went on in today's context are really nothing short of horrendous. I mean, some of the things that people did in those days is something which securities people, banking people would look at with absolutely unbelievable amazement. We have had a number of laws, specifically in the securities area, which I think has essentially eliminated the vast proportion of them. We have a lot of remaining problems, as Chairman Reuter, I'm sure, will address, but things have changed really quite considerably. Secondly, let's also remember that investment banking per se need not be a terribly unstable or high-risk business. It really depends on what you do. I mean, there's a lot of investment banking operations, for example, which basically have assets marked to market every night and short-term financed in a manner which is fairly appropriate. And in many instances, a number of, not the larger ones, a lot of smaller institutions are actually hedged overnight, meaning that they go from the close of business one day to the open of business another day with very little risk. So, I mean, it's not that there's something fundamentally inherent in securities powers. There's no question that if abused like anything, it can be very risky. So it's really a question of how it is done, if it is done, what the form of regulations are, and basically how one prevents the types of problems which one considers could arise from occurring.
My time is up, Mr. Chairman, but let me just follow and ask you, when is it that you might be able to give your recommendations to us on this issue? You indicated that's being looked at now.
It's underway now. I would say several weeks, but we're moving. The more you look at this, the more complex it gets.
That's what I'm concerned about. Thank you.
The gentleman's time has expired. Chair recognizes the gentleman from Oklahoma, Mr. Simon.
Thank you, Mr. Chairman, and welcome, Greenspan. I was kind of disappointed in your testimony, to be very honest with you. I didn't really find anything in there that gave me any indication where you all were going. So let me see if I can get you to be a little bit more specific. I'd like to know what kind of a structure you'd recommend. You're saying that you believe that the bank should be able to get into some expanded services. What kind of a structure would you envision?
Well, Congressman, if you found that my testimony was vague and not to the point, I regret that I was trying to do something close to that.
So you accomplished what you wanted to do.
Well, you told me I have.
You.
I appreciate you telling me that I succeeded. And let me tell you the reason why. First of all, if you asked my personal views, I would be able to give them to you on all of the questions we've been getting up here. I'm not speaking for myself. I'm speaking for the Board of Governors. And when we come up with a proposal, I want to make certain that it is theirs, not mine. And as a consequence of that, until we have had full discussions, and we are in fact discussing these issues, there's a remarkable degree of unanimity on lots of issues, probably less so on others. But I don't think it would be appropriate for me until we've gotten some fairly firm views down to come up here and give you opinions which we subsequently would have to retract.
Now, this is not a new issue. I mean, I can't imagine that you all at the Reserve have not thought about this for some length of time. And as your statement says, you know, you expect Congress to be very active in this area. There hasn't been anything preliminarily decided over the years that we should be aware of, is there?
You mean by the board?
Yes.
Not to my knowledge, no.
Let me ask you this. Can you comment today about whether or not the structure that you would recommend and the services that you would recommend, whether or not those services should be under the jurisdiction, let's take securities, for example, should that be under the jurisdiction for enforcement by Reserve, or should it be done by the SEC?
Well, that's actually one of the issues which we're looking at. I mean, as I understand, Chairman Reuter is in fact making recommendations of certain types of functional regulations in the certain securities areas, brokerage area. We're looking at that, and we will have a response to that as such. I mean, we don't have anything preordained about whether we should be going to functional or other forms of regulation. I mean, I think they both serve very useful, all various different structures serve useful purposes, but you have to define what it is you're trying to do before you decide how you do it, and that's what we're trying to do.
Well, I appreciate those comments, and as a member that believes that we should be active in this area, as Jim Cooper said, your recommendations on what kind of structure we should have and who should be involved in that structure, but more importantly, who should enforce these measures, and those recommendations from you would be very helpful as we move down this legislative process. Thank you, Mr. Chairman.
Gentleman's time has expired. The chair recognizes the gentleman from Tennessee, Mr. Cooper.
Thank you, Mr. Chairman. I'd like to congratulate our distinguished witness because already after a short time on the job, I think he is as hard to pin down as Paul Volcker was. I don't know where you take lessons in Delphic utterances, but I think you passed the course. What I'm trying to decide right now is whether this period of indecision is your way of turning back the clock or whether you're waiting to get your feet on the ground. And I'm going to ask you some specific questions to see whether the Fed is willing to stand by some of its past decisions, some decisions in the very recent past. For example, the August decision to allow blind brokerage systems. Is that still the Fed position?
Yes, it still is the Fed's position.
How about the April decision to allow certain large money center banks to underwrite commercial paper, mortgage-backed securities, municipal revenue bonds, and securities backed by consumer installment debt?
I must say, of no changes or no second-guessing on any recent rulings by the Board of Governors.
So all past decisions still stand during this period of review?
None of my colleagues have indicated otherwise, and I therefore presume that to be the case.
Well, how about the philosophy of your predecessor? He was last on record before Congress, I believe, specifically endorsing the granting of 4 different bank powers: underwriting revenue bonds, commercial paper, mortgage-backed securities, and allowing banks to get into mutual funds. Is that a statement that the Fed still stands by?
Well, I would say philosophically, I would suspect yes, but I think we're now getting into a much broader question which really occurs as a consequence of the moratorium ending, I think it's March 1st, and the endeavor on the part of the Congress to relook at the whole structure in a broader way. So what I would suggest here is that, what I would indicate here is that of necessity, the Board of Governors has had to look at much wider issues than individual rulings, merely to in our endeavor to try to be helpful to the Congress in addressing the issue which you are in the process of endeavoring to resolve. So I would say that on the one hand, the general philosophy that the board has enunciated in recent months is, I think, one which is still there, but I think the specifics are really getting to much broader issues. Mr. Swift stated before he had to leave that he thought that the Congress was abdicating its responsibilities in this area, and that the regulatory agencies were in effect doing too much. Well, in a sense, I agree with him. I think that it is the bailiwick of the Congress to construct legislation so that we have guidance on what it is we are doing. And now that the Congress seems to be desirous of doing precisely that, our focus is moved into this area, and we're now thinking in terms of the broader principles that are implicit in the type of legislation which the Congress now seems on the edge of considering.
I still think it's important to find out the degree of continuity, if any, in Fed policy. It's my understanding that you're the only new member of the Federal Reserve Board since many of these decisions were taken. So if anyone is a new factor, it is you. And yet you're using the others to have a wait-and-see attitude.
Well, let me be very specific, Congressman. If you are asking me, are there any of the recent rulings of the Federal Reserve Board which I feel strongly is a mistake? The answer is no.
Thank you for that specificity. I appreciate that. How long do you think it will take the Federal Reserve to look at some of these broader questions and then come back to Congress with specific recommendations? It takes Congress a long time to act, as you know.
No, I understand that. No, I hate to put a date on it because we're in the process of considering it. It's weeks, not months.
So you think the committee should invite you back at that time when the period of review is completed to find out the...
If it's in the committee's interest, certainly.
Mm-hmm. If, and let me jump ahead here to some of the deeper issues, if it does turn out to be possible to insulate subsidiaries of banks or bank holding companies from all these evil effects, would you be in favor of substantial modification, if not repeal, of Glass-Steagall? Is insulation, in your mind, the paramount question?
Yeah, I would say it's the paramount, but not the only question. There are a number of other collateral issues which are involved. Let me just say this. In recent weeks, and I think largely as a consequence of the interest of the chairman of the Senate Banking Committee, Mr. Proxmire, a number of people have all of a sudden begun to review the whole Glass-Steagall history and the potential of changes there in a way which I don't think anybody really seriously looked at previously. And needless to say, we too are doing the same thing. I would say that the condition of insulation in one form or another is a necessary, in my view, but not a sufficient condition. That there are other smaller issues, but you're certainly correct. I would say that is unquestionably the most important question, but not the sole question involved.
How would you rank some of the smaller questions involved other than the insulation question?
I'd hate to do that at this stage.
Mm-hmm. It seems to me that an undercurrent in a lot of the statements we've heard today is that this is all a one-way street. Banks are wanting to invade the territory of securities firms. And to me, it's a two-way street. And a lot of the invasions have already occurred in the other direction, namely securities firms invading the traditional territory of banks. That is often characterized, when it is admitted, as a market development or an inevitable consequence of an advance in technology, when in fact it can also be explained somewhat more parochially as just an outright invasion of another person's turf. Would you agree that this is very much a two-way street that we're looking at when we're resolving these difficulties?
I would certainly hope so, Congressman.
It struck me in particular that some of the questions, in fact the three key questions that our chairman put forth for consideration, are questions that can also be asked of the securities industry. For example, how can we insulate insured deposits from securities activities? That works both ways. How can we ensure the continued safety and soundness of and public confidence in banking and securities markets? Works both ways. And the third, how can we prevent conflicts of interest and concentration of resources? That certainly, above all, works both ways, because the Chinese wall is just as interesting a barrier as the Glass-Steagall wall. Would you agree, and this would be my last question, the time allotted, that if Congress fails to decide, if Congress continues to delay, that there is no way that the marketplace will stop moving and developing, and that we cannot say here in the Congress something like, stop the world, I want to get off, or stop the world, give me more time to make up my mind, that a moratorium, even when legally in place, does not stop the marketplace from moving. And our failure to decide would in fact be a decision in this case.
Yes, I think it would, Congressman. What it would do is, because you're getting a considerable continued pressure coming from the marketplace, that inevitably forces pressures on the regulatory agencies, ourselves included. And we are forced to try to interpret what the Congress would have done if it had done it. I think that's not a particularly useful set of guidelines for us. I cannot say to you that there's any desire on the part of the Federal Reserve to extend our regulatory reach. What we are creatures of federal legislation in this area, and we seek guidance. And the more guidance that we get, the better off we are.
Thank you, Mr. Chairman.
Gentleman's time has expired. We'll go for an additional round of questions. The Chair recognizes itself once again. And I'd like to bore in, if I can, Mr. Greenspan, on a question which was raised by Mr. Taki, and that is that the Glass-Steagall Act was enacted after very careful consideration and after much intensive investigation, and represented, at least in part, a response to abuses that were believed to have caused a host of bank failures during the Depression era. How can we ensure that those sorts of failures will not occur again? Your predecessor, Mr. Volcker, used to say facetiously, we've gone 40 years without a bank crisis, let's make sure, let's make some enormous third world loans. How can we make certain that if we were to permit an expansion of banking activities, that those activities would neither foster nor exacerbate conditions which could lead to substantial financial problems for the banking industry?
Well, Mr. Chairman, let me just take a step back for a minute. You have to distinguish between the abuses which occurred, and there was extraordinary abuses which occurred in the late 20s, and the evidence that these in turn were instrumental in significant bank failures. There has been, in the recent literature, as I recall, a number of analyses which suggest that the tie is by no means clear. And in fact, in the vast majority of instances, the types of institutions which failed had nothing whatever to do with securities issues. I think to a large extent the Glass-Steagall Act was a response to abuses which did not in and of themselves create huge numbers of bank failures. That was caused by other things. I think that what you want to do is to be certain that to whatever extent changes are made, and I think some changes are going to have to be made because the markets are in fact forcing that, but whatever extent changes are made, that we try to understand as best we can what caused the problems of the 20s and the 30s and whether they would exist in any new environment constructed under the resurrection, partially or fully, of the types of institution which existed before Glass-Steagall.
We are in the process right now of examining those questions, and clearly part of the concern that we have is the changes that are happening in the world, regardless of what Congress has done in recent years. You expressed some satisfaction with the fact that there will be an expiration of the banking expansion moratorium next March.
I certainly hope so.
What are the dangers lurking in your mind if that moratorium is extended?
I think what you do is you lock in the status quo in a regulatory sense when market forces are changing fairly rapidly for reasons over which we have very little control. What you do is you create inefficiencies, you create quasi-monopolies, you create concentration of certain areas which are undesirable. In a sense, you create a non-competitive environment, precisely the opposite of what the intention of the Congress would be.
All right, well, let me ask the flip side of the coin. What are the consequences if the moratorium is not extended? Will there be a race to the regulator, a race to the courthouse in order to further break through in new areas of bank powers?
I would suspect there could very well be. I don't know that for a fact, but I wouldn't certainly rule that out.
In what areas do you think that the banks are most likely to begin their new incursions into the...
I hope that is a wholly hypothetical question, Mr. Chairman, because if the Congress proceeds with legislation, any such discussions, I think, will be eliminated.
The March 1st deadline is one which looms legislatively on the horizon. And because of that, we would have to have some sense of the urgency with which it would be necessary for us to act. And if there are no impending substantial negative consequences in terms of extending the deadline, that is, that if we did not extend it and the banks were out but not substantially engaging in new types of activities, then it would give Congress more time to deliberate. So we'd have to get some sense of what new activities were being considered.
Well, I'm not in a position to answer that question in any useful manner because it's hard to know what will develop over the next number of months, what new products, what new ideas, what new legal insights certain banking institutions might or might not have. The one thing I would say with a reasonable degree of assurance is that it is highly risky to keep that moratorium in place beyond March 1st.
Okay. Commercial bankers and other opponents of the Glass-Steagall Act argue that the securities industry is oligopolized. Do you agree with that assessment made by opponents of Glass-Steagall?
I don't think so.
You do not think so. How would you characterize the existing
Well, I'd say that
securities
the
industry?
best way of determining whether true oligopolies exist is whether freedom of entry is available. And I know of no industry in which it is easier to get into if you have adequate capital and have capabilities as in this industry. There are so many little boutiques around, so to speak, which are very efficient, very effective, and very profitable.
Do we need more entrance into the market in order to ensure that there are competitively priced services?
I'm sorry, we're talking now about banking
in
or
the investment banking area.
Investment banking?
Do we need, and in the securities area, do we need new entrants, or does that already exist in terms of sufficient cross-section of pressures that ensure that there is competition and consumer benefits?
It's not actual new entrants that you need, it's the possibility of new entrants. Meaning by that, should there be, let me give you a very specific point. Supposing somebody devises a specific type of exotic product in the investment banking business whose basic purpose is to try to find a certain type of risk hedge which is not available. In the early stages of the introduction of that product, the originator is likely to do exceptionally well and make very large profits. But unless he has some extraordinary advantage, he is going to get competitors very quickly, whether they be de novo, meaning individuals coming in who are not in the business previously, or people who are currently in the business. That will immediately eliminate any so-called monopoly or oligopolistic profits.
But that does not exist, you're saying. There is no monopoly or oligopoly.
Not to my knowledge.
So I guess what I'm saying is that the argument that you need more competition does not necessarily, in terms of just ensuring that there is a competitively priced services for customers, is not an existing problem. There are other reasons to do it, but that is not necessarily one of them.
That's correct. I must say to you, Mr. Chairman, there are other questions. I mean, the people who raise this issue about oligopolistic prices or oligopolistic profits are raising an interesting question as to why there has been a fairly significant concentration of certain type of investment banking functions amongst a very few firms. That's not caused by the inability of firms to enter into the business. It's caused by the fact that boards of directors tend, when seeking investment banking advice in many areas, try to get those firms with substantial historical reputations. And as a consequence of that, until reputations are expanded amongst a number of the smaller firms, it is difficult to get into certain types of businesses. But I would not consider that oligopolistic in the sense that there are actions taken by these firms to inhibit entry. It just turns out that they've managed over the years to build up exceptional reputations with the public. And that's a franchise which we should encourage, not try to destroy.
Okay. Well, can we look at it from the flip side, which is that, is there a potential that allowing investment banks to get into this area could lead to a decrease in competition? That is, that the Citibanks of the world will, that is, if we allow the commercial banks in, if we allow the commercial banks in, that will allow for a decrease in competition as the Citibanks begin to buy up our largest securities firms, and you wind up with the law of unintended consequences taking hold, which is that rather than, ironically, more competition, you have less as the larger institutions begin to swallow up these other comparatively smaller firms.
Yeah, you know, it's an interesting question you raise, Mr. Chairman, because free enterprise economists like myself tend, I hope, to try to always argue precisely that question. Will that happen? I mean, forget our theories, you know, that it's not supposed to happen in theory, but can it happen? And I think it's incumbent upon all of us, especially those who are strong deregulators like myself, to be especially sensitive to that type of question, and I hope we will be.
It is possible, then?
The word possible, yeah, do you mean possible versus likely?
It is possible that could happen.
Well, it's possible. My impression is it's not likely. Is the history that we've seen in the interstate banking area, where the larger banks are moving in and taking over smaller and smaller, taking over more and more small banks. I'm sorry, you're talking about intrastate?
Interstate.
Interstate.
Interstate banking. Is that is that a trend that gives us some insight into the likelihood of them moving into this commercial banking area and taking over already existing security firms?
I don't know the answer to that, but I will tell you that if the presumption is that small investment firms or small commercial banks have a absolute disadvantage in all respects against larger institutions, I think the facts are against that. What we have learned in the commercial banking area is that when larger commercial banks, for example, endeavor to move their branches into areas where smaller banks are functioning, that they don't necessarily do very well. Investment banks, smaller ones, which we often call boutique-type operations, in the specialized areas where they try to concentrate their resources are often much better than the large investment banks. So I'm not, so long as free capital is free to move, so long as investment is free to move, it is very difficult, if not impossible, to create either monopolistic or oligopolistic positions in the securities or in the commercial banking area.
I'd like to ask you just a couple of quick questions, and then my time will expire. You've expressed concerns about the level of corporate debt existing in the United States today. Your predecessor, Paul Volcker, expressed similar concerns. When you walk through a bookstore today, it seems as though there are as many economic gloom and doom books on the shelves as there are diet books. And there are any number of economic observers who are predicting some impending financial catastrophe. Many of those books discuss the enormous levels of debt on the balance sheets of United States corporations. If there comes a time when, in your view, corporate debt is reaching alarming levels, a view already held by some, what actions are available to the Fed that you may use in order to inhibit the growth of corporate debt?
There are certainly no simple tools. I mean, the type of tools that the Federal Reserve has were we desirous of curbing that, the tools that we have available clearly don't come to that issue, and were we to use the tools that we do have available, we probably would create, as you point out, unintended consequences which would be worse than the debt problems themselves. I might say that the debt problem has not been worsening recently. It's gotten, in fact, if anything, slightly less worse.
Yesterday on the David Brinkley Show, you made some interesting observations regarding interest rates, recessionary environments, and the Fed's monetary policy. And I particularly noted your response to a question that sought to get you to predict the timing of the next recession. You stated that no one has repealed the business cycle, and that we could have recessions in our economic future, but the current economic indicators were not signaling one. My question to you, Mr. Chairman, is if we do experience the onset of a recession in the next few years, how will America's corporations weather the storm? When you testified before this subcommittee in April, you expressed significant concern about the level of corporate debt, much of it brought on by hostile takeovers and leveraged buyouts. At that time, you stated, quote, as a consequence of mergers and acquisitions, leveraged buyouts, and corporate stock repurchase programs, the net liquidation of financial corporate equities has approximated $230 billion since the beginning of 1980. Interest payments as a percent of non-financial gross operating income currently are running at approximately 31%, unquote. In a recession, that sounds like a prescription for corporate disaster. Is the debt structure going to cause our corporate sector and, as a result, our economy as a whole greater headaches during the next recession?
Well, I would say by almost inevitably that to to the extent that debt burdens rise and fixed costs as a percent of gross operating cash incomes rise, then there is less flexibility to take a significant recession. I think we have to distinguish between a recession and a severe recession, because clearly the order of magnitude here is very crucial to how one comes out.
Can I ask, just interjecting there, could the existing levels of corporate debt help to turn a recession into a severe recession because of their inability to withstand the shocks?
I don't think we're quite at that level, but I am concerned about the overall level of debt, not that it could have significant impacts on the economy overall. I'm more concerned about what it would do to the individual companies and the corporations unless they get a better balance of debt equity.
We're not quite there yet, but are we approximating that point?
I would say that, exactly, we're not there yet. A few more years of the type of debt accumulation that we had seen, or more importantly, which is really the crucial question, the change in debt equity ratios. That's the real basic question.
And where are we in terms of that?
Well, the problem here is, and it's a tough one to evaluate, because if you do it on a book value basis, then debt equity ratios have risen quite significantly. The trouble is that when you mark the balance sheets to market, this very sharp increase in stock prices has flattened out the rise in debt equity ratios, and if anything has made them look a good deal better. So it's a hard call in the sense that whether one should be looking at book or market values. If you were looking strictly at the market values, you probably would not at this stage be terribly concerned. But the book values certainly give you a different picture.
So you are very concerned in looking at the...
I am concerned, but not to the point where I think we're on the edge of some significant problem. This is a problem, I think, for this country over the longer run. Certainly not this year, next, maybe not for 5 years, but it certainly is a type of problem that unless we find a means of handling, I think will make adjustments in the business sector somewhat more difficult.
But there are certain individual corporations in this country that you would have to be concerned with in terms of the amount of corporate debt that they've assumed and their ability then to withstand...
Without question.
Okay, thank you. Time has expired. The chair recognizes the gentleman from Oklahoma, Mr. Steiner.
Thank you, Ed. Just a couple of things. Let me see if I can summarize what you've tried to tell us today. First of all, you've told us that you would defer to Congress on the policy questions. You also have told us that the overriding factor should be the benefit to the economy and not to shore up any institutions, any decisions we make. You've told us that you think we need to find the right structure to put in place in order that we might do a good job enforcing and also to regulate that structure. Finally, you've told us this morning that failure to decide on these issues are unacceptable, basically. Let me go back to the second thing you've told us this morning, that the overriding factor should be the benefit to the economy and not to shore up any institutions such as banks. You've said an oligopoly concentration within securities shouldn't bother us. You have said that the free flow of capital should be the overriding factor. How do you define benefit to the economy?
I define it very specifically as benefit to the consumer, because ultimately it's consumers and through business back to consumers where the ultimate value choices in this economy is made. If consumers put a high value on a certain type of financial service, then the providers of that service will make money, and they will do it. And if consumers are not particularly interested in a certain type of service, it will disappear. And so ultimately what we should be endeavoring to do is to try to consider what is it that is the most benefit to consumers of financial services in this country, and as a collateral issue, the structure of the financial institutions on the economy as a whole.
What services are being denied consumers today that other people around the world have that we don't have?
I'm not sure that I could give you a list at this specific point. We have an awful lot of products that are out there. The crucial question is not what's available in the rest of the world, but any products which consumers might want, which they are unable to get.
Can you give us an example of that?
No, I don't. As a matter of fact, I think at the moment, one of the issues that we're confronting is the fact that we have accomplished a good deal of commercial banking deregulation, especially in the acts passed by the Congress earlier in this decade. And as a consequence, we're creating an awful lot of new types of products all the time, some of which are not profitable and pulled away, which is another way of saying the consumer didn't want it. And I have a general view that we shouldn't be listing all of the various things that we should be constructing as powers for our depository institution. That presupposes we know what consumers will want. I'm more inclined to give generic powers in which you are, in a sense, saying to the depository institution, provided you adhere to regulations A, B, C, and D, that you can produce in a generic way products which you think might be valuable and profitable, and let the purveyors of new financial products decide, not either the Congress or regulators. We don't have that capability, and in fact, if we stipulate a long list of products which we say are desirable and should be embodied in legislation, I will guarantee in 5 years from now that legislation will be obsolete.
Okay, let me go to my final question. You said that it would be highly risky to continue the moratorium beyond the date of next spring. Now, would you still say that if Congress fails to act and does not regulate in any sense in this area?
Well, what I mean by risky, I mean by the fact that I think that the moratorium at the moment is not something I would subscribe to as desirable. The longer you keep it on, the longer you freeze the system, the more distortions that are going to build up behind it. I'm not saying that on March the 2nd, if you extend the moratorium, some catastrophic calamity is going to occur. Of course it's not. But I think it is the type of risk which has no real benefit on the other side. In other words, if it was a risk for which you got a real significant trade-off and you weren't willing to take the risk, that's fine. But I see no practical use of extending the moratorium when, in effect, what it tends to do is merely create further distortions, which is likely to make it even more difficult for the Congress to enact rational legislation.
That's a good answer. It wasn't the answer to the question I had. The question is there a higher risk with or without regulation on that date?
I would say there is, if the Congress did nothing, yeah, I would say there is less risk in removing the moratorium.
Less risk?
Than in keeping it on. Ideally, would be to have the Congress enact new legislation.
Thank you.
When this time has expired, the chair recognizes the gentleman from Tennessee, Mr. Cooper.
Thank you, Mr. Chairman. Chairman Greenspan, I don't want to be picky, but it seemed to me that in your answer to the oligopoly question, you relied on the economic definition of oligopoly, which is perhaps more technical than most people who are listening to this might realize. And I think that, as my colleague Mr. Sinar's question implied, we often intermingle the two terms.